If you own VBAL, XBAL, or any balanced ETF, you already own bonds. You may not know exactly what they are, how they work, or why they're in your portfolio. Most stock investors don't. And for most of the time, markets are going up. It doesn't matter much. The bonds just quietly sit there, paying a modest income while the stocks do the heavy lifting. But then 2022 happened. In 2022, the stock market fell sharply, and something that was supposed to cushion the blow, bonds, also fell sharply. The traditional 60-40 portfolio, 60% stocks and 40% bonds, fell approximately 16% in 2022. It was the worst year for bonds in modern history. Stock investors who owned bonds as a safe part of their portfolio were blindsided. Why? What happened? And more importantly, does it change whether bonds belong in your portfolio? To answer any of those questions, you need to understand what a bond actually is. Not the textbook definition. The real explanation: what a bond does, how its price moves, why it behaves the way it does when interest rates change, and what role it plays for a Canadian investor building a portfolio in 2026. That is exactly what this video covers. A bond is a loan. That is the entire concept. Everything else is detail. When a government or a corporation needs to raise money, it has two options. It can sell ownership, that is a stock, or it can borrow money, that is a bond. When you buy a bond, you are the lender. The government or corporation is the borrower. They promise to pay you back the original amount, called the face value or par value, on a specific future date, called the maturity date. And while they hold your money, they pay you regular interest, called the coupon, typically every 6 months. A simple example. The Government of Canada issues a 10-year bond with a face value of $1,000 and a coupon rate of 3.5%. You buy it. For the next 10 years, the government pays you $35 every year, 3.5% of $1,000, in two $17.50 semi-annual payments. At the end of 10 years, you get your $1,000 back. That is a bond. A loan with a fixed repayment schedule and a defined end date. The three key bond terms every investor needs: face value, par value, the original amount the borrower promises to repay at maturity, almost always $1,000 for individual bonds; coupon rate, the annual interest rate paid on the face value. A 3.5% coupon on a $1,000 bond equals $35 per year, regardless of what the bond's market price does. Maturity date, when the borrower repays the face value. Short-term bonds mature in under 3 years. Medium-term in 3 to 10 years. Long-term in 10+ years. Who issues bonds? Government of Canada. The safest Canadian bonds, backed by the federal government, currently yielding approximately 3.2% to 3.6% depending on term. Provincial governments, slightly higher yield than federal. Ontario, Quebec, BC all issue bonds. Municipalities, city-level borrowing. Corporations, higher yield than governments because there is more risk of default. A Bell Canada bond yields more than a Government of Canada bond because Bell Canada could theoretically go bankrupt. The Canadian government cannot. Investment grade versus high yield. Bonds are rated by credit agencies: Moody's, S&P, DBRS. Investment grade bonds, BBB- and above, are considered relatively safe. High-yield bonds, sometimes called junk bonds, are rated below investment grade and pay higher yields to compensate for higher default risk. Here is the part that confuses most investors. Bonds have a face value, the amount they will be repaid at maturity. But bonds also trade in a market every day, and their market price moves, sometimes significantly, between the day they are issued and the day they mature. Why does the market price of a bond change if the coupon and face value are fixed? The answer: new bonds are constantly being issued at current interest rates. Imagine you hold a Government of Canada bond paying a 2% coupon, issued in 2021 when rates were low. Then rates rise to 4%. New Government of Canada bonds now pay 4%. Who would pay full price for your 2% bond when they can buy a brand new 4% bond? Nobody. Your 2% bond becomes less attractive, and its market price falls until the effective yield to a new buyer equals the market rate of approximately 4%. This is the foundational bond relationship. When interest rates rise, existing bond prices fall. When interest rates fall, existing bond prices rise. They move in opposite directions, always. The yield explained: the yield on a bond is not the same as the coupon rate, unless you bought the bond at exactly face value. Yield is the actual annual return you receive based on the price you paid. If you paid $900 for a bond with a $1,000 face value paying a $35 coupon, your coupon income, $35 per year. Your price discount, $100 over the remaining term. Your total yield, higher than 3.5%, because you are earning the coupon plus the guaranteed gain to face value at maturity. If you paid $1,100 for the same bond, your yield, lower than 3.5%, you paid above face value and will receive less than you paid at maturity. Duration. The interest rate sensitivity measure. Duration measures how much a bond's price changes for each 1% change in interest rates. A bond with a duration of 10 years falls approximately 10% in price for every 1% rise in yields. A bond with a duration of 2 years falls only approximately 2%. This is why long-term bonds are much more sensitive to interest rate changes than short-term bonds. A 30-year Government of Canada bond is dramatically more volatile in price than a 2-year Government of Canada bond, even though both are equally safe in terms of getting repaid. Here is the vault, the specific relationship between bonds and interest rates that caused 2022 to be the worst year for bonds in modern history, and why it matters for every Canadian investor. In 2020 and 2021, central banks around the world, including the Bank of Canada, cut interest rates to near zero to combat the economic impact of COVID-19. The Government of Canada 10-year bond yield fell to approximately 0.5% in 2020. Bond prices were at historic highs because rates were at historic lows. Then, inflation arrived. In 2022, Canadian inflation peaked at approximately 8.1%, the highest in 40 years. The Bank of Canada responded with the most aggressive rate hiking cycle in its modern history, raising the overnight rate from 0.25% in March 2022 to 5.00% by July 2023, a 475 basis point increase in approximately 16 months. Now, apply the bond price relationship. When the BOC rate goes from 0.25% to 5.00%, all existing bonds, locked in at 2020 to 2021 low coupon rates, became dramatically less attractive relative to new bonds. Bond prices fell sharply across every term and type. The Canadian Aggregate Bond Index fell approximately 11.7% in 2022, its worst year on record. Long-term government bond funds fell even more, some 20 to 30%. At the same time, stocks were also falling. The TSX fell approximately 5.8% in 2022. The result? Both the stock component and the bond component of a 60-40 portfolio fell simultaneously. The diversification benefit that bonds are supposed to provide, cushioning stock losses, failed in the specific scenario where both assets were hit by the same enemy: rising inflation and rising rates. The lesson? Not that bonds are bad, but when bonds struggle, bonds underperform or lose money in one specific environment, when interest rates are rising from low levels. In every other environment, falling rates, stable rates, recessions, deflation, bonds provide exactly the cushion they are supposed to. In 2026, with the BOC rate at 2.25% and inflation at 3.2%, the rate environment is meaningfully different from 2021. Bond yields today: approximately 3.2% to 3.6% for Government of Canada bonds, already price in the current rate environment. For bonds to repeat 2022's losses, rates would need to rise sharply again from current levels. That is possible, but not the base case. The yield curve, reading the bond market's view of the future. The yield curve plots bond yields across different maturities. Normally it slopes upward. Longer-term bonds yield more to compensate for the longer wait and more uncertainty. When the yield curve inverts, short-term yields exceed long-term yields, it historically signals that the bond market expects rates to fall in the future, typically because a recession is coming. The Canadian yield curve was inverted in 2022 to 2023. It has largely normalized in 2026. Even if you are a pure equity investor who will never buy a single bond directly, understanding bonds matters for 4 specific reasons. Reason 1. Bond yields tell you what the market thinks about the future. When stock market professionals say, "Watch the bond market," this is what they mean. Bond yields reflect the market's collective expectation for inflation, economic growth, and central bank policy. When 10-year Government of Canada yields rise, it typically signals that bond investors expect either higher inflation or stronger economic growth ahead. When yields fall, the reverse. The bond market is a real-time economic forecasting machine, and stock prices respond to it constantly. Reason 2. Interest rates affect every stock's valuation. Stock valuations are based on the present value of future earnings, discounted back to today using a discount rate. When bond yields rise, the discount rate rises, and the present value of future earnings falls. This is why growth stocks and technology stocks, whose earnings are expected far into the future, fall the most when bond yields rise. The Microsoft sell-off earlier in 2026 before the earnings results was partly driven by this mechanism. Reason 3. Bonds cushion the portfolio during recessions. In most recessions, not the 2022 inflation shock, but the typical recession driven by economic weakness, the central bank cuts rates to stimulate growth. Falling rates mean rising bond prices. A Canadian who held bonds in the 2008 financial crisis saw their bonds rise significantly in value as rates were cut aggressively, partially offsetting the catastrophic losses in equities. This is the seatbelt function of bonds. Reason 4. You likely already own them. VBAL is 40% bonds. XBAL is 40% bonds. VCNS is 60% bonds. Any balanced or conservative ETF holds bonds as a core component. Even XEQT holds a small bond allocation through its Canadian equity component's bond-like characteristics. Understanding what you own is basic financial literacy. Do you need bonds in your portfolio? The honest answer depends on 2 things: your time horizon and your psychological tolerance for volatility. If you are under 40 with a 20-plus year investment horizon, a 100% equity portfolio, XEQT or VEQT, is appropriate for most people. The long-time horizon means you can ride out market downturns without needing the bond cushion. The higher expected return of equities compounds powerfully over 20 to 30 years. The 2022 scenario, both stocks and bonds falling, was painful for 60-40 investors, but was actually the better outcome for 100% equity investors because equities recovered faster than the bond portion did. If you are within 10 years of retirement or need to draw funds soon, a bond allocation starts to make sense. The purpose is not to maximize returns. It is to reduce the probability of a severe loss at the worst possible time. A retiree who experiences a 40% portfolio loss in year 2 of retirement and is also drawing down the portfolio faces permanent impairment. A 20 to 40% bond allocation reduces this sequence of returns risk. VBAL or XBAL, 60% equities, 40% bonds, is the standard starting point. How to buy bonds in Canada. Most Canadian investors should not buy individual bonds. The minimum purchase size, complexity, and lack of diversification make individual bonds inappropriate for most retail investors. The better option, ZAG BMO Aggregate Bond Index ETF, Broad Canadian Bond Market, MER 0.09%, current yield approximately 3.8% to 4.0%. VAB, Vanguard Canadian Aggregate Bond ETF. Similar, MER 0.09%. XBB, iShares Core Canadian Universe Bond ETF. Similar, MER 0.10%. These ETFs hold hundreds of Canadian government and corporate bonds, providing instant diversification at minimal cost. GICs versus bond ETFs, the Canadian retail investor's choice. For many Canadians, particularly those approaching or in retirement, GICs, guaranteed investment certificates, are a more accessible alternative to bond ETFs. A GIC at 3.5% to 4.0% for 1 to 5 years provides guaranteed return of principal, CDIC deposit insurance up to $100,000, no price volatility, no mark-to-market losses, comparable or better yield than short to medium-term bond ETFs today. The trade-off: GICs lock up your money for the term. Bond ETFs are liquid. For the stability-seeking investor who does not need liquidity, GICs are often the better choice in the current environment. Where to hold bonds in your Canadian accounts? Bond income, interest, is taxed at your full marginal rate, the least tax-efficient form of investment income. Therefore, hold bonds and bond ETFs in your RRSP or RRIF, where the interest income is tax-deferred. Do not hold bonds in a TFSA if you have equity room. Equities are more tax-efficient in the TFSA because their growth is entirely tax-free. Reserve the TFSA for equities. Reserve the RRSP/RRIF for bonds and bond ETFs. Let's come back to where we started. Stocks fell. Bonds also fell. The 60-40 portfolio lost approximately 16%, and investors who owned bonds as a safe component were blindsided. Now you understand exactly why. Rates rose from near 0 to 5% in 16 months. Every existing low-coupon bond became dramatically less attractive. Bond prices fell sharply in response to the rising rate environment, the one specific scenario where bonds struggle. And you understand why it was the exception. not the rule. In recessions, in deflationary environments, in periods of economic stress where central banks cut rates, bonds do exactly what they are supposed to do. They rise in price. They cushion equity losses. They are the seatbelt, not exciting, not the engine, not the reason you get in the car, but the thing that protects you when something goes wrong. In 2026, with Government of Canada yields at 3.2% to 3.6%, meaningfully higher than the near-zero starting point of 2021, the income from bonds is real. The starting yield is not artificially compressed, and the risk of a 2022-style repeat requires rates to rise significantly from already elevated levels. Bonds belong in Canadian portfolios at the right time, in the right accounts, in the right proportion for the right investor. Under 40 with decades ahead? Probably not yet. Approaching retirement? Yes, and increasingly so. In your RRSP or RRIF, not your TFSA. Through a low-cost bond ETF or GIC, not individual bonds. That is what a bond is, and that is why it matters.